Let's talk to Marc Ostwald. He's the strategist at ADMISI. Very good morning to you, young Marc.
Good morning.
Right, 5 thought-provoking slides. Probably best that you get on your soapbox and run us through them. Fire away, sir.
Right, the yellow line on that chart is the US 10-year yield. The white line is the Bund yield. I think what right-hand scale is the Bund one. So notably, it looks like quite a dramatic chart, but actually the Bund yield at its extremes has traded basically 25.75 for the whole year. That's hardly a dramatic movement in capital terms. That's precisely 4 points. And okay, we've had a little bit of choppiness back in April, May, but of late, actually, when you look at what we've seen since the beginning of the month, the Bund future has traded in a less than 1 point range since June the 29th, which is not exactly going to be making people a lot of money.
Okay.
And as for the US 10-year, it's caught. It's a classic example of being caught. We are looking at real yields. We had the CPI data yesterday.
Yep.
2.9%. US 10-year yield is 2.85%. It's negative in real terms. And you might think that's appropriate if we were in a situation where, say, inflation was down at 1, but it's not. It's 2.9. If unemployment was, say, up at 8 or 9%, you might think that it's appropriate, but it's 4. That when the economy is not growing, but it is, we're looking at something like 3% for Q2, and we've got the earnings coming up next week, and apparently, from what I gather from some of my equity colleagues, they're rather discouraged by the fact that we're only looking at a 20% earnings increase.
Wow.
Okay, some of that may be financial engineering, but it's still 20%, and we haven't seen many 20%ers in many quarters, apart from the last one, for a very, very long time. So it really underlines that we're still in a very, very favorable financing environment when you look at those long-term yields. And it probably starts to explain when one starts to look at some of the other asset classes, if we move on to the next chart, why there's nothing going on. Yes, back in February, we had that big kerfuffle, I think is probably the best way of describing it now, where we were thinking, well, maybe the equity market has finally turned. Well, it certainly doesn't look that way now. And in volatility terms, we seem to be back to our old habits of seeing any rise in volatility, even the small one that we saw in June, because it was modest, either in the S&P 500 or in the Euro Stoxx 50. And the Euro Stoxx 50 bears some thinking about, because we've had all this political turmoil. We've been worried about German politics, Italian politics, Spanish politics, and yet that's the whole reaction in volatility terms. So really it underlines that there's still a lot of money hanging around, and at every opportunity it's looking at every dip to buy. And this carries on. I think it's instructive, because we seem to be in what I'd call a very Pavlovian reactive market, which basically only has one way of behaving, because we've got stuck in this central bank swamped world. So let us go on to the next thing. So we've been a little bit concerned, I think particularly towards the beginning of the year, where one can see we had a fairly sharp widening in US high yield bond spreads and bond yields as Treasury yields rose, and indeed people were concerned that perhaps this is going to be a slightly less inviting environment to chase yield. But no such case. Every time we've seen throughout this year that we get one of those spikes higher, there is another charge back into high yield bonds. Yes, no doubt about it, the fact that the US 10-year yield is still only 2.9. It may have come up from 2%, but it's still only 2.9.
Yep.
If you're charging someone 1.5% in fees for managing, they're going to come out with something like 1%.
Right.
So no wonder people are still chasing the so-called high yields.
Yep.
It is worrying in the sense that actually now 71% of all US high yield bonds in current circulation are so-called covenant light. So if we do have an accident at some stage, the protection for investors is that much less, and it may be very, very good for vulture funds, for people who come and pick up the scraps. But those people who've been invested basically have little or no protection. And that is worth bearing in mind, given the appetite that's still out there. Let's move on. Emerging market bonds. Obviously, we know that the rising dollar has taken its toll to some extent on emerging market bond yields, foreign currency yields this is, and spreads have widened. But in the greater scheme of things, yes, at the beginning of the year, we clearly got way beyond our station by taking down that spread down to 290. But we've only widened it at the worst this year to 390,
yep.
and we're already back into 368, displaying again this behavior of buying every dip. And I think it's important to understand that there's actually only a couple of villains in here, and some of those, the pair of those villains, Turkey, which we'll come to in a moment, and Argentina, have seen their yields rise dramatically. So if we were to exclude those, the chart would look even less dramatic. It'd probably actually start to look quite a lot like that high yield bond chart. So here we have the story with Turkey, and I know I've talked about Turkey before, but I do think we're at a very nasty juncture. This is local currency bond yields. Average has got up now to 19%. The Turkish lira hit a new all-time low yesterday morning at 4.97 versus the dollar. It's not so long they redenominated at 1-to-1 versus the dollar. It's only just over a decade ago.
Right.
So that is quite some devaluation. And we're in this situation where Mr. Erdogan, with his expanded powers as the president, has decided in his wisdom to encourage favour with international investors, not to appoint his son-in-law as the finance minister, when the original finance minister, Mr. Simsek, along with the central bank governor, was seen as one of the only two more reliable elements. So Turkey is definitely a problem, and it's going to become more and more of a problem as we go through the year, because they, above all, have a lot of debt to start that they need to refinancing. Refinancing locally, obviously, is going to be prohibitive. Refinancing in dollars is also going to be hugely problematic,
yep.
given the fact that they've obviously seen that huge devaluation, and the bulk of them actually have their revenues in Turkish lira. Therefore, the cost of refinancing dollar debt, a lot of which has been borrowed to invest in Turkey's infrastructure. So in the energy sector, there are going to be some problems there. And it is actually rather worrying, because by rights, when you look at Turkey, you see that actually the corporate sector has less than 100%. Its debt to GDP ratio is less than 100%. Typically, any country is 150 plus. So it's very, very low. So they should actually be in a good position, relatively speaking. But there's a lot of this infrastructure-related debt in the energy sector, and that's going to have to be refinanced. And it's going to be interesting to see whether anyone actually has the appetite for picking it up. I'm sure there will be brave souls who look at the absolute levels and say there's a fat risk premium, who do, but it is going to be tricky.
On that note, Mark, thank you very much indeed.